Hey, what's going on, cash flow hackers? It's Chris with Life 180, and today we are talking about probably one of the more common questions and comments that I get from people, which is, why would I put my money into a whole life insurance policy right now for cash value return when I can get 5% in a CD, 5% in a high yield savings account, even though those rates are coming down a little bit, 5% in bonds? Ultimately, this is probably one of the more common comments that I get from people. And so my endeavor in this video is to kind of show you why I still love whole life insurance and why I think it's so important to kind of take a look at whole life insurance as a foundational asset in your life for that fixed money. Now, what I will say is that there are a lot of different people that kind of look at things differently, from investments and savings and so on and so forth. But my definition of saving is being able to put your money somewhere, get a return on it, and not have any risk of losing that money, okay? So that is the biggest thing. There has to be guaranteed returns inside of that fund, inside of the asset, to be able to consider it a savings vehicle. An investment vehicle, even though I understand that the technical Webster definition of an investment is something that you get a return where your asset is worth more later, and you know that is technically the definition of an investment. But the bottom line is, I don't look at it like that, because for me, the definition, we have to look beyond just the Webster Dictionary definition. We have to look at definitions through the lens of actual life and how these assets work. And for me, investments come with risk and savings come with guarantees. And there's a place for both in life. I'm a huge risk taker. I love investing. I love taking risks on things that I know I can get massive returns with, that can improve my lifestyle, that can increase my cash flow, that can do all these different things. However, we need to make sure our financial foundation is set first with assets that are guaranteed and that will have savings components to it and other benefits that will solve other needs in our life. And so that's what I'm going to do today. So ultimately, there's a couple things going on. Obviously, with rates anywhere from 4 to 5% in the fixed market rate, there's a lot of things that have happened over the last couple of years. There's been inflation. Rates went up to 5.5%. You could get that in a high yield savings account. We did a lot of stuff with MYGAs, which are annuities, like 5-year annuities, that people were able to get 5.75% for a 5-year clip and lock those rates in for a long period of time. However, since that time, over the past year, rates have been coming down again because inflation's dropping, federal funds rate is dropping. As the economy starts to slow or continues to slow, the federal funds rate is dropping and interest rates are dropping. You've seen mortgage rates come back down a little bit. All these things are happening. The bottom line is, we don't know what the future holds. We don't know what direction the federal funds rate is going to go. It could go up, it could go down. But what we do know is that we are still near all-time lows, even where we are right now. Rates could potentially go up. If they go up, how does that impact everything that we're doing? How does that impact your bond funds? If you invest in bonds, it actually has a real negative return potential on what your funds are performing at. And so how does that impact all the other options, and how does that impact your whole life insurance? I'm going to talk about all these different things on why you would want whole life insurance in that environment. However, on the other side, what happens if rates go back down? We don't know what way they're going to go, but I'm a big believer we need to prepare for the worst and hope for the best, right? And make sure that whatever financial strategy that we implement, whatever tools that we use, that we can win and succeed, whether we have the outcome and the projection in the economy that we're hoping for, or if it goes kind of sideways on us. This is kind of one of those things. So what I want to do is I want to hop here and I want to talk a little bit about kind of a concept. And I did this in the last video. And if you've watched my videos, you know, like the last video, this was kind of inspired. This whole conversation, this whole dialogue was inspired by a gentleman who is going through and contemplating purchasing whole life insurance, but now he's got questions, and I get it. I love it. Nobody should ever put money into something they don't understand. And if they have questions, they should dive deeper. And this is why I love this. I love getting challenged, and I love coming to this point. And so you could see here, this is what happened from 1980 And I did this in the last video a little bit, so I'm not going to spend a lot of time on it. If you want to go back and watch that one, you can go get a little bit more detail. But from 1980 to 2009, we had federal funds rate go from 19% all the way down to zero. We had quantitative easing for the next decade. And now interest rates after COVID kind of went back up. And now they're kind of sitting around, let's just call it the 5% mark, even though I think they dropped a little lower than 5% recently. But we're just going to, for sake of simplicity, call it 5%. So in 2025, okay? And so when we look at this, the question is, what happens? Well, what we know is that a lot of people built their beliefs about what to do and how to invest, how to save, and how the economy responds in different scenarios. They built their assumptions and beliefs in this reducing interest rate environment. So what I know is that how we make money in an increasing rate environment, or maybe a flat environment, or an environment that doesn't have as far to fall, right? We're already at 5%, which from a long-term perspective, our federal funds rate currently, right now, even though it feels high for the economy, and I feel like a lot of people believe that if the federal funds rate were to go higher, it would put too much stress and tax the economy and we go into a recession. Therefore, they're thinking about, they're considering and have been looking at dropping the rates again and going back down. But I'm here to tell you that we're still below the long-term average for the federal funds rate. So there's nothing healthy about our economy right now. And I don't know what way this is going to go. The one thing I know is that the government has been really good at their ability to manipulate the economy and kind of kick the can down the road on dealing with all the problems that we have to deal with. But coming to the point of this video is comparing whole life insurance. And you can see what I have here is I have whole life insurance and I have a tabulation. And what I have is I have the full tabulations to kind of show you the calculations for 5% fixed rate accounts and 4% fixed rate accounts, taking 15% taxation into account, where that would be like a capital gains, 15% capital gains. Let's face it, I'm assuming people are saving $24,000 a year, which is $2,000 a month effectively. And I'm assuming that if you're able to save $24,000 a year, then you're probably at least a 15% capital gains tax bracket. Or if you're claiming it as earned income, which sometimes is going to be the case for people, that's potentially a higher bracket. And if you're even a higher net worth person that's saving more and you want to scale this up, this tax bracket's actually higher than this. And so I'm kind of going on the bottom end of the taxation element with this, just to be conservative and show that whole life is still a powerful asset and competes really strongly. Now, one of the things that I've said, my buddy Tom Wall wrote a book, and he's got his PhD in retirement income planning, and he did a study as part of his PhD that said that showed a rolling period for the last 90 years, and it showed that every 30-year rolling period for the past 90 years, whole life insurance has always beat bonds. However, every 10-year rolling period for the last 90 years, bonds always beat whole life. So what we have to do is we have to figure out what is the long-term goal of what we're after. When we're looking at this asset and you look at trying to get returns, trying to keep liquidity, trying to get all the ancillary benefits that come out of this, you have to take all these things into consideration. So what I want to do here is I want to just kind of do a little comparison of the summary, and then I'll go into detail here, right? So you can see here, and I'll zoom in here just a bit for you, okay? So you can see here that this is the 5% return, 15% taxes, and this is a 10-year period, 15-year period, 20, 25, and 30. So I did a 5-year, starting at 10 years, I did kind of 5-year increments all the way up to 30 years. And you can see that I funded this right here, $24,000 a year for 20 years. So a total of $480,000 contributed, all the way down to $240 at 10 years and $360 at 15 years. Now, and you can see that it didn't increase. So we stopped paying, so we stopped saving in this example, and we just let the money compound from year 20 and beyond, just assuming that, you know, the person was getting close to retirement at that point in time, and maybe they just wanted this money as a volatility buffer or an emergency fund or like kind of a bond alternative, or maybe it is their emergency fund and bond portfolio, CDs, whatever, in retirement, because this is what a lot of people do, right? The whole 60-40 bond portfolio idea, this is the kind of asset that whole life insurance is a better alternative for, and this is, I'm about to show you why I believe that's the case, okay? So you could see that if we accumulated with no taxes, you could see that 5% over 30 years with this is $1,357,000. It's just not realistic. $1,357,000. A lot of people will compare that to whole life illustrations when they look at whole life and they're like, oh, if I just earn 5% over 30 years, I'm going to crush whole life. But the bottom line is then they have to realize that they're going to pay taxes. And what they really come to after paying their 15% annual taxes only on the gains, right, is $1,159,000. Granted, that's not bad. They've had a net gain of $679,000. So they've more than doubled their money in a savings kind of alternative, I would say. Like I said, some people would call it investment, and it is what it is. But once again, this 5% is still a little bit high, I believe, because I do believe that interest rates are going to go down. I also believe that if they go up, what we look at for whole life insurance is whole life insurance performance will also go up. So what I'm trying to do is just compare it with apples versus apples, right? And the reason for this is saying I'm comparing it at 5% because that's kind of where we are in the environment right now. But I also know that a lot of people right now only have access to, say, 4%-ish accounts. And I will also say that if rates go down into the 4% range, which I think is really realistic, even if rates drop a bit, whole life insurance dividends are not going to drop. They're going to kind of remain where they are based on the fact that whole life insurance dividends are near the lowest rates that they've been in the past 90 years. And so when we look at this, this is the 5% account. Now what I want to do is I want to go to the whole life, and I've got the summary for the whole life insurance net values, and then I'm going to go into the details. I'll get into this in a little more depth. Now, 10 years paid, this is the years, the same 10, 15, 20, 25, 30, right? The premiums, same deal. We paid $24,000 a year in premiums. I wanted it to be apples to apples, and then we paid the policy up. You never paid another dollar into the policy. And I'm going to show you the illustration that will kind of back all this up later. And you can see the tax-free accumulation. Mind you, this is tax-free. You have $1,133,000 with a $1,458,000 death benefit. So you can see here that compared to a fixed asset at 5%, which, by the way, this is assuming everything stays at 5% right now. But the bottom line is, kind of like I showed, I think I didn't show it here, but I'll do it now, is that the reality is over most periods of time like this is what interest rates do. They go like this, right? And so what whole life is supposed to do is kind of like flatten the curve, right? And there's going to be times when the fixed asset markets are better, and there's going to be times where whole life will actually perform better when the fixed market is worse. But the bottom line is the market will go up and down. It goes in a wave. It's not a linear thing. It kind of ebbs and flows. The whole idea of our economy and Keynesian economics is the Federal Reserve, like it or lump it, has the ability to increase and decrease the federal funds rate and control and manipulate the economic environment based on the supply of money. And they do that by raising and increasing and decreasing the interest rates. That's just how this works, okay? And so when we look at this and we say, all right, 1,133,000, well, when we compare that to whole life insurance at a 5% taxable fixed asset, well, after 10 years, whole life insurance is behind by $34,000. Okay, that's not good, obviously, right? But what do you have? You have an additional legacy. You have an additional legacy, comparatively speaking, of $474,000 at that point in time. So yes, you're a little illiquid comparatively, but from a legacy play, you have $474,000 in additional legacy that goes along with it. At year 15, you can see you're a little more behind. At year 20, a little more behind. But then beyond that, 25, year 30, it starts to go down. And if I were to continue this trend, because we paid up the policy at year 20, there's no more charges, fees, or anything, this thing gets more and more and more efficient as we go. It's important to understand that. And so as we look at this, you can also see that the whole time, let me just focus on year 30. At year 30, you're only $26,000 behind. That $1,133,000 is only $26,000 behind the $1,159,000 in a taxable 5% vehicle, okay? So you're only $26,000 behind. Over that many years, you're talking about a rounding error, And this could easily be made up based on little fluctuations in dividends, or if that 5% asset isn't even available at that point in time. I look at, to me, that it more than makes it worth it to go with the whole life direction, even if it's a little behind, because you get this $299,000 increase in potential legacy compared to the 5% return. Now, why does that matter so much? Well, because in addition to this, you have access to living benefits. Now, a lot of people, one of the responses that the gentleman gave me was, I don't need living benefits. I have health insurance. Well, I share the story about my father-in-law who was diagnosed with stage 4 pancreatic cancer. And he had health insurance, and his health insurance was they give him a 90-day death sentence. And his oncologist basically said, no, there's not much we could do for you. We'll give you chemo and radiation, and that alone, the doses that we have to give you, because we found a 7.5 centimeter tumor that was on your pancreas that spread to your liver. Like, if anybody knows anything about pancreatic cancer, like, that's pretty much a death sentence. And what we were able to do was accelerate the death benefit, get it tax-free, do alternative medical treatments, and he's still alive 4 years later now, 4.5 years later. That was November 4th, 2020 when that happened. And he's still alive and playing golf and, living his life and enjoying himself. And when we look at that, what is the benefit of that? It is having more control. And so what is it worth to have that control, to have that extra $300,000 that you could use for living benefits if you need something, right? That, to me, it's worth this $26,000 illiquidity. But once again, now this is assuming this 5% environment that we're in. What happens if we go down to a 4% environment, right? And that rates go down, and you put your money into a CD, and then next year when you go to renew the CD, instead of 5%, you're getting 4.5%, and then maybe it goes to 4%, and maybe it goes to 3%, or maybe whatever. But so let's just focus on what happens if it goes to 4%, or what happens, by the way, if you put your money into a bond fund and you're getting 5% in this bond fund, and you buy it today, and then rates spike, and in an increasing rate environment, your bond fund's going to get massacred. And yeah, sure, a lot of people go, well, if I buy it now and rates go down, I'm winning, kind of like people won in the bonds in the 80s and 90s and early 2000s. But the bottom line is there's much less room to go. You might have a good year or two in that environment, but then still long term, the market's going to have to come back up. The rates are going to have to come back up, and then you're going to hurt in that process again, right? So just things to take into consideration. Bonds, I think right now, with where we are in the economic environment, because of rates being so low, they're just so much more risk than people want to consider, with very little upside return. And so if you're looking at safe money, whereas over the past 40 years, a lot of people have leaned on bonds to be that safe money, I think that idea is kind of gone at this point in time until the interest rate environment changes again. So when we look at the options, let's just call this a money market or high yield savings account or CDs or something of that nature, right? You could see that this is the account value that matters, that we're comparing against after 15% taxes. And I will show you, let me go down here. Oh, this is the tabulation of it. You can see it at $24,000, 4% returns. These are returns, taxes on the gains, return value, and then we did it, repeated all the way. You could see by year 10, $1,681 in taxes that year, $289,000 of cash value, and then this goes all the way down to where you have $970,000 in cash value, $821,000 at year 25, $694 at year 15. So now when we go to this and we say, all right, these are where these numbers come from, right? Well, how does that compare to whole life insurance, which is more realistic? Well, now what we do is we zoom in over here, whole life insurance compared to a 4% taxable asset. Well, yeah, it's still behind at year 10 because we have all these benefits. We have the fact that additional legacy compared to a 4% return, we got an extra $488,000 of legacy. Yeah, sure, we lost this $20,000 of liquidity, and we had a little bit of a less return, but we've got all this big legacy here. We have the ability to access the cash value in this policy without interrupting the growth, which is another benefit I'm going to talk about here in a bit. But then at year 15, you're only $9,000 behind, and you got a much bigger legacy bump. When we talk about inheritance, is that there's that, and then at year 20, we are $19,000 ahead in a whole life policy compared to a 4% taxable asset. and we have $620,000 in additional legacy return. Now, that's at year 20. The one thing I want to say is that we used a 20-year term rider on this policy to be able to jam the cash value into it and to be able to do what we're doing. And so you can see there that the legacy drops from 620 to an additional 434. The reason that this drops is because at year 20, the term rider expires. However, who cares? Because at this rate, you're $85,000 ahead at year 25 in the cash value inside of the whole life policy. The tax-free accumulated cash value is $906,000. And by the way, this is assuming dividend rates near the lowest that we've been, right? And so even in the low rate environment that we've been in, if rates kind of go down again, dividend rates have less far to fall than other rates. And if the fixed interest rate environment continues to go up, well, dividend rates will increase. And so this number will actually increase as well. We don't know what it will do. I don't have a crystal ball, but I think it's just important to understand the principles of how these things work. What I do know is when we just compare apples to apples on a spreadsheet, comparing the environment to environment, and with today's expectations and considerations, even if things stayed like they are today for the next 30 years or 25 years, you're looking at $85,000. And then at 30 years, you're looking at $162,000 more in the whole life policy than you are in the 4% return account, which is a huge, huge deal. Plus, in addition, you got $488,000 more legacy play. So you not only have more cash value, but you get these extra benefits. And with that, you have living benefits that go along with it, that if you become critically, chronically, or terminally ill, and you decide that you want to handle your treatment and have control of your treatment in a way that your health insurance company doesn't want you to do, you can do that. You can utilize this to stay alive and to do treatments that the medical cartel will not allow you to do with their money, right? So that's, to me, when I look at this, it becomes a big no-brainer because of the fact that, like, I'm looking for my money to solve multiple problems. And yes, I'm a little behind on cash value compared to the 5% fixed assets right here during the whole time. There's no doubt comparatively that I am. But I think because of the fact that interest rates, we don't know where they're going to go. I think if they go down, whole life is going to blast past whatever 5% asset that you're going to put your money into right now. If interest rates go up, if you had your money in bonds, you're in trouble. But if you had CDs, yeah, you could take advantage of that. But I think also whole life insurance dividends are going to go up. Once again, when we look at a long term, the goal is to flatten out this curve. Whole life insurance traditionally beats these fixed assets every 30-year rolling period because the insurance company general fund managers are managing that risk. And when we look at the legacy planning, when we look at the tax advantage benefits of it, it becomes a no-brainer. Now, the other thing that I think is really important to this is that we can access our money. And I want to do this. I'm going to come to the actual illustration here. So this is the illustration that I used, okay? And now you could show this, and I'm gonna speak to this a little bit right now. Let me just highlight. So what I want to do is speak to this a little bit. You can see that I've paid $24,000 all the way through year 20 right here, right? So this is where I funded, and now you can see that I did a reduced paid up. That's the key terminology here, okay? So I did a reduced RPU, reduced paid up at that point in time. So what do we do there? What we do for an RPU is we reduce the death benefit, we pay up the life insurance, so there's no more fees that go along with this. So it becomes just basically like a fixed asset on steroids because you get all these other benefits that go with it, right? And so when you look at this, what we have is we have the cash value accumulating, and this is where down here, I will show you down here, this is where, the $1,133,000, the 906, the 722, right? All the numbers that kind of come into play here that we were focusing on. This is the thing. We have these assets. We have access to this money. And the cool part about this is, like, if you had your money in a CD and, maybe you had $500,000 at this point in time, and you had your money in a CD, and I'm going to go over here and just kind of draw for a second, and you had 500,000. at that point in time compared to the 470 that we have here. Well, if you want to pull your money out of that CD to spend it on something, you now, let's say you wanted to take 250,000 out. You have 250,000 left, and whatever you did with that money is now gone, right? It's now, maybe you put it into an investment and it's earning something over there. But the question is, what's going to happen? You interrupted the compounding and you took risk with it, which is no problem. You just got to understand it. The difference is with whole life insurance, with this 470, if we want to borrow against it, we can borrow $250,000, right? We can borrow that 250, and right now we're going to pay a percentage. Let's just say we're paying 5.5%. And so this is a big thing that comes into play because we can leverage this for other value. Maybe, and I don't know what the interest rate environment's going to be in 15 years. That's the bottom line. It could be 6%. It could be 4%. I've seen these loan rates on policies range anywhere from 7% all the way down to 4%, quite frankly, and it's all over the map. But at the end of the day, you would think with this math that we only have $220,000 left in the whole life policy. But the answer is that's not accurate, because we're not actually taking the money out of our 470. We're borrowing against it. We're leveraging it. We're utilizing this $470,000 as collateral to be able to get a loan from the insurance company on a guaranteed basis for this 5.5%. So what happens is, even though we do that, this full $470,000 is earning a dividend, right? So we could see what that return is simply by saying, okay, it's hard to do at year 15 because of the fact that we're still contributing a premium over here, so it's really hard to do the math. But like if we go down here where we know there's no premium at 756, so it's easy to go $756,346 right there divided by 791,534. And you can see, if you do that math, it's like a 4.6% return, okay? And a lot of people say, oh, that's not good, because if I'm paying 4.6, if I'm paying 5.5 and earning 4.6, that makes no sense. I'm still losing money. I'm still paying for that. Well, the answer is it's not that simple, because if you're utilizing this for cash flowing assets, what's going to happen is I can show you mathematically, and I have other videos on this that show you that you can pay this if you just do nothing except for manage the interest expense. And if you earn compounding 4.6%, that you come out way, way ahead mathematically. There's no way around it. You just do every time. I can show you how you pay 6.5% compared to earning 4.6% over a 10-year period of time, and you're going to come out ahead with that 4.6. The key there is that you need to make sure you manage this 5.5% interest expense every single year. Now, the other thing is, if you wanted to avoid all of this with whole life insurance, once again, it's about flexibility. It's about control. If you said, hey, I need to access money with this, there's a thing that we do. It's called withdrawals up to cost basis. So you know that you've paid in $480,000 in this policy. That's what we've done in this period of time. $480,000 is our cost basis. So you can withdraw up to $480,000 out of this cash value without paying taxes, and you still retain all the rest of these benefits. You withdraw through partial surrender, and you can do that, and you still have these other benefits left, and it will still grow like this. And so, once again, the flexibility that whole life provides and the benefits that it provides you are unlike anything else that exists. The fact that you can have access to that money, that you never have to interrupt the growth of that money. You can utilize it for real estate investing, for business. You can utilize it as a volatility buffer. It's a bond alternative, a CD alternative. You're going to get comparable rates of return, like I showed you. And in the situation that you're a little behind, the benefits that you get, it's so marginally behind that the benefits are worth the cost. Because if you think about it, what are your options? If you are thinking about needing long-term care potentially, and if you become critically, chronically, or terminally ill, what if you need some kind of assisted living? Well, your health insurance isn't going to pay for that. What are you going to need? You're going to need to go get long-term care. And what is that long-term care going to cost you? And when you compare the fact that you're $30 to $40 to $50,000 behind, well, if you've ever looked at long-term care insurance over that period of time, well, then you understand that this becomes the biggest no-brainer in the world. And the last thing that I want to say to that is, like, people don't realize that, well, I'll say it like this. Is that most people don't think about it in terms of what I want right now or what I need long-term. They think about it in terms of where I am right now. And so somebody who's 44 years old is very, very seldomly thinking about what do I need when I'm 75, right? And that's just reality. It's human nature. It's hard for us to imagine. I mean, if you look at the way the world has changed so much over the past 35 years, 40 years, it's almost incomprehensible to even consider what the world is going to be like 30, 35 years from now. So I think it's a folly effort to try to believe that we're going to be able to understand where we're going to be. So we don't. And I think because of that, our subconscious is just focused on today and we don't realize. But one of the things that I love about this is that this policy is going to grow with you. And so what you lack on the short term, right? If you go back to here, what you lack on the short term in this situation, with whole life insurance, I'm going to just zoom right in here. What you lack in the short term, you're also solving big problems in the long term, maybe 20, 30 years from now, that a lot of times people kick the can down the road and they don't address them until they're 60 or 65 when they go, oh man, what if I need long-term care? What if I want some additional supplemental coverage? What if Medicare, Medicaid isn't what I thought it was going to be 20 years ago? Because I don't know about you guys, but I feel like there's a chance that whole system is going to be adjusted. I don't know how. But I know that as a country that's $36 trillion in debt and it's getting worse and worse and worse. And I just know that we can't keep kicking the can down the road. And I think that's what this Doge experiment is all about, trying to get government inefficiency in alignment. And who knows what kind of cuts or changes that we're going to make. I think we're seeing things in a way that we can't even comprehend or even try to figure out what it's going to look like 20 years from now. So the only thing I know to be true is that we got to take responsibility for our own lives. We got to take radical accountability for the results in our lives and making sure that we and our families are protected and we have a financial structure that's set up. So when I look at the fact that short term, sure, $35,000, but I don't know a person alive that can save $24,000 that would, 10 years from now be like, all right, I don't mind. Yeah, I think everybody would be okay with the fact that I'm 34,000 behind compared to a CD, compared to a bond fund, or compared to a savings account, if that $34,000 solved a lot of problems for you moving forward, right? Even if it was 10, 15, 20 years out. That's something to take into consideration. And then when you take into consideration also the additional legacy play that goes along with it, that's just kind of icing on the cake, right? And then you take into consideration that 5%, there's no guarantee that this is going to stay that way. It's going to flux up and down, up and down, up and down. And, if it fluxes down a little bit, you can see the difference between 5% in a fixed account and 4% is a huge deal. It's the difference of whole life being behind by $26,000 or whole life being behind or ahead, whole life being ahead by $162,000. Guys, that's almost a $190,000 swing just with a 1% difference in return in fixed assets. So when people say, Chris, why do you like whole life insurance so much? This is my answer, because this is like when I look at this and you look at everything just beyond the spreadsheets. I mean, I could spreadsheet this stuff out all day long. And at the end of the day, you got to come to your own conclusions. You got to align your money with your values, your beliefs, and understand and think long-term and figure out what are the problems that I need to solve in my life and go from there. So I've been thinking about doing this video for a long time, finally having a conversation with a client potentially who's really kind of pushing back on me on this. And I love it because this forces me to think deeper. It forces me to go down into this, and this is how I create my content. So I'm grateful for the experience. I'm grateful for the conversation, and I'm grateful that there are people out there that are really looking to go deep on this stuff. So if you have any questions, comment in the comment section below. Can't wait to hear what everybody says. The last thing I want to say, because I know there's this guy, Mark F., that always comments on my video. He's going to freak out and be like, but the life insurance keeps your cash value. I want to say this. So Mark, this is for you and all my trolls that agree with Mark, because you could go and you could put your money into this 4% account, right? 30 years from now, and you're going to have $970,000. You could put it into the whole life insurance policy, and you're going to have $1,133,000. And now you're going to say, well, Chris, I would have rather, I don't know why you would rather have this 970, or let's even say you got the $1,159,000 in the 5% account, and you're going to be like, oh, well, not only do you have a little less, $26,000 less, but the life insurance company is going to keep your $1,133,000. It's always compared to what? If I were to save up in this account and die, and they get $1,159,000, and then I were to save up in my whole life account and die with $1,133,000 of cash value, that's not actually what's happening here. They're dying and they're leaving $1,458,000, which is $300,000 more of a legacy. Because you have to understand, as the cash value goes up, the death benefit increases as well. And so there's always going to be a gap. And the life insurance company, they could separate the tax-free accumulation and the death benefit and say, all right, we're gonna pay you your cash and we're gonna pay you your death benefit, which would be this over here on the side, so to speak, right? They could pay your death benefit, which would be a smaller number than this above the cash value. They could do that, but if they were to do that, the taxation would not be tax-free. It would be taxed and managed just like all these other accounts. And so what all these people like Mark and Dave Ramsey and Susie Orman like to rail on whole life insurance companies about with this, it is actually one of the greatest benefits and greatest structures, and one of the reasons that some of the wealthiest people in the world understand and do this, because they understand the tax-free nature of the death benefit and what that does from a legacy play, all without having to risk the liquidity and being able to access that money at the same time. So that's my mic drop for today. If you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. And if you haven't already, if you're a life insurance agent and you're looking, check out, we have our event coming out. I'm doing our first national event where we're going to be doing a deep dive training. It's a 2.5 day event in Scottsdale, Arizona, August 21st through 23rd. Really excited about that. And if you're watching this right now, April, if it's not too late, April 28th through May 3rd, down here in the Dominican Republic, I'm doing a mastermind, high-level mastermind for elite life insurance agents who are looking to take their practice to the next level. So check it out below. I will put the link in the descriptions below. Till next time, have a blessed, inspirational day. Talk soon. See ya.